Hi, if you're watching this, then you know this is probably the first attempt I've made to try to record some of these lectures on overview of income taxation for your benefit later on. It's a real experiment, so I'm sure I'll be embarrassed by a lot of what I see myself doing and saying later on. But anyway, it's a start, and I hope it helps you to maybe catch on to some of the topics maybe where you didn't quite get everything you thought you should earlier. And here we go. Tax Freedom Day 2017 arrived on April 23rd of this year. It's about the same day as in 2016. What that represents is the number of days it takes for the average American taxpayer to earn the income necessary to pay the taxes that they owe for that particular year. This is a large amount of money. Americans will collectively spend more on taxes in 2017 than they will on food, clothing, and shelter combined. That means that Americans will work 113 days into the year in order to pay the taxes that they owe. Specifically, the income and income-related taxes, federal, state, local income taxes, plus income-based payroll taxes. So you can see from this that income tax is a pretty significant portion of the average person's expense, and so not something to ignore. So the fact that you're studying income taxation, I hope you will see, is in fact something that will benefit you and allow you to benefit others through the knowledge that you have for years to come. This first section on planning your income tax strategy is more than 1/3 of each dollar that you earn will go to pay taxes. An effective tax strategy is vital for successful financial planning. And of course, understanding tax rules and regulations can help you reduce your tax liability, help you put you in a position to make better decisions about your investments, about your expenditures, about planning for the future, your education, retirement. You'll see all kinds of applications, I hope, as we go through this course. To help you cope with many types of taxes, you should know what current tax laws are as they affect you. Maintain complete and appropriate tax records, and make purchase and investment decisions with the tax implications in mind to help you reduce your tax liability, and to make sure to plan for your liability and your obligations as well. Your tax planning should be targeted toward paying what you owe and nothing more. I know of certainly no legal obligation to pay more than the law requires, nor is there any moral obligation, despite what we sometimes hear, people who think someone hasn't paid their fair share because they paid a lower percentage of their income in taxes than maybe somebody who's less well off. That's for you to decide, but realize that notion of fairness is a very subjective one, and there will always be someone who thinks that you probably haven't paid as much or done as much for them as maybe they think you should. There are two important terms here that come into play: tax evasion and tax avoidance. I strongly advise against this on both legal and moral grounds. Tax evasion is the legal understatement of your tax liability. Tax avoidance, on the other hand, is the legal minimization of taxes. I strongly advocate and encourage this, and I strongly stand against that, and I encourage you to think about that. Don't put yourself in a position where you're taking overly aggressive or stretching the law. It's just not worth it, certainly for moral grounds, but also legally. It's not worth the sleep and the stress, the sleep you would lose, and the stress that you would subject yourself to in order just to save a few dollars. So be careful about that. Make sure you understand the distinction between avoidance, which I am recommending, and evasion, which I'm recommending against. There's also, I think, in your notes a statement about I recommend that you don't pay taxes if you don't have to. And secondly, that if you do have to pay taxes, delay them. That is, postpone legally the payment of those when you can. We'll talk more about that later on. There are taxes all over the place. Taxes on purchases, including sales tax, consumer use tax, excise taxes. The distinction between these, I think you probably are familiar with sales taxes. When you purchase something as a retail customer, you pay sales tax. That's an expense or cost to you. The retailer is going to collect that money from you and then transmit it to the government, to the taxing authority. In Alabama, it's by the 20th of the month. That is, when the company figures its sales for the month of August, by the 20th of September, it will need to remit the sales taxes that it collected to the state of Alabama, the Montgomery County, and the city of Montgomery as well. Consumer use tax, we've talked about, I think, in class earlier today. And then the excise tax. Excise tax is really a tax on producers of goods or on middlemen, really, somewhere along the way. Not on the ultimate customer or buyer of that good, the retail customer, but those who go sell those goods, really. Don't fool yourself. The fact that somebody else pays the bill doesn't mean that ultimately you don't pay part of it as an expense. Then just like insurance and advertising, salaries and wages and such, the seller of a good is going to bill some portion of that to the degree that they can into the price that you pay for that good. So I like to say this: somebody with skin ultimately has to pay every tax that there is. It's either going to ultimately be paid, even though it might be a corporate income tax, or you might say, well, it's an excise tax on the producer. It's going to be paid by somebody, either the customer, by the employees through reduced wages, or possibly through the owners of the company through lower returns, creditors of the company through maybe lower interest payments. Somebody's got to pay for those taxes ultimately. You may not think it's you, but in fact it may end up being you in some, not explicitly, but implicitly. Taxes on property, real estate, property taxes, personal property taxes. Real estate has to do with taxes on land, buildings, and land improvements. Personal property taxes are on basically any type of physical asset that's not land or buildings. Your automobile, a boat that you might own, those are going to be pieces of personal property. Taxes on wealth. Really, I suppose you would say these are taxes on the transfer of wealth itself. When you die, your assets, liabilities move into a legal fiction called the estate. And so the estate really is where your assets go and your liabilities and such go when you die. And then state law and your will determine the disposition of those assets. So there's a federal estate tax that limits, let's say, the amount of money you can transfer in death. And there's state inheritance taxes. This is a tax on the estate itself, that is on the decedent, or the one who's dying and transferring property to heirs. The state inheritance tax, really, and many states have them, not all may have them, but many do. Alabama does, for instance. That's really a tax on the heirs. And so that's really a tax on the recipients of that wealth that's transferred by a decedent to heirs. Taxes on earnings. Of course, the income tax is the one that we're talking about here, and it's the primary focus of this particular course, once we get through some of this introductory information, as you'll see. Consumer use tax, we talked about a bit today, is an interesting tax because it's one that you report and pay individually. Primarily, it's related to products that you buy online from out of state that you receive here in Alabama, where the seller has not withheld sales tax on you. If that's the case, actually, the state of Alabama says then you owe, it's not a sales tax, mind you, because the sale took place elsewhere, okay, but it is a use tax, specifically a consumer use tax. And on the Alabama income tax return at the bottom, you'll have a place there for reporting any taxes that you owe. So if you haven't paid sales tax on, what you're supposed to do is figure the sales tax that's due to the state of Alabama and then to remit it as part of your income tax return. What tax record should you keep? Well, here we go. First of all, a copy of previous year's tax returns. How far back should you go? In general, 3 years. We'll look at that in a little more detail in a minute. Well, maybe I'll wait on that. W-2 forms. If you have income from employment, then by December 31st, or no later than that, you're supposed to get a W-2 form that shows what your taxable income is, actually your gross income, how much has been withheld for FICA, for federal income tax, state income tax, possibly any other types of deductions for retirement contributions and things like that. We'll take a look at some W-2 forms, probably a number of them over the course of this semester. But that's more or less the notice that you receive, that the employee receives from the employer, that is the basis for preparing an income tax return. Other forms, 1099, and of course these are the Internal Revenue Service form numbers, 1099 and 1098, fairly common forms that many taxpayers, I bet like your parents, would be familiar with if they've got some kind of a savings account at the bank or at credit union, for instance, or a brokerage company. They'll get a 1099 that reports that to them. If you've got a home mortgage, then you're going to get a statement from the mortgage company, and it's going to show you the amount of mortgage interest that was paid on your behalf during the year. That's a Form 1098. Receipts and documentations for expenses really should be maintained. Anything really that pertains to your income tax return, items of income, items of expense, deductions, things like that, even receipts, should be maintained, along with investment and business expense documentation. Probably now, these days, through advances in reporting, you're going to find that a lot of information is provided to you by not just your employer, but by banks, by brokerage companies, and so on. So it's easier now, but it still is something where you've got to stay on top of these things. You don't throw those envelopes away, without thinking about it at the in January. It may look like a credit card bill, but it may in fact be some sort of information on how much interest that you've paid on a particular loan during the period. The Internal Revenue Service recommends the taxpayers keep their returns and any supporting documentation for 3 years at a minimum after the date of filing. After that, the statute of limitations for an IRS audit expires. Statute of limitations really limits the length of time that in this case, a particular governing authority has to come after you to prosecute or to pursue some sort of legal action against you. However, don't be fooled. If you don't file, if you've underreported income by 25%, the IRS can go 6 years back, or even 7 if other issues are involved here. If you don't file, if you simply didn't file a return, or if you file what they determine to be a fraudulent return, that is, there was the intent to defraud the government, to underreport income, to overstate expenses. That's typically what happens. The IRS has no statute of limitations. It's certainly pretty safe, I would say, to save just all your information for 7 years. You may not have to. You find you can throw it away earlier, but just in case. These days, it's much easier, of course, to have that information scanned, so that you got the information, but it doesn't take up a lot of space. You have to be pretty well organized. Have basic organization so that you've got your returns and your documentation that you maintain. You know where it is, so that if there is a question, you don't have to sweat much about trying to find that. If you're paying state income taxes, the time you need to keep records will depend on state law, so it's best to check your state requirements. Generally speaking, though, you're going to find that state reporting requirements are pretty much in line with federal requirements. As a matter of fact, for some states, you can pretty much take some of the federal forms and just substitute those for certain schedules, for instance, in the state form. There's a lot of overlap, but there are some differences too that you'll need to be aware of. Okay, let's look at the process of actually calculating your income taxes. Now, you see a Schedule 2, well, let's see, Section 2 on the back of this page is, I'm looking at the time, okay, that's 14 minutes. Let me just refer you to this. On that page of your notes, we're not going to go over that, but it really just sort of gives you a visual picture of what we're about to cover. And that is the overall flow of the income tax return. We're going to start talking about gross income and what's included in that. And then we will deduct from gross included certain specific items that lead to a value that's called adjusted gross income, or AGI. That term AGI comes up again and again and again. And so, of course, part of our attention this semester is going to be figuring out what goes into gross income, what are those deductions in arriving at AGI, and then go from there. You'll see that after we hit AGI, then we've got a number of deductions. First of all, the standard and the itemized deductions, and then what are called personal exemptions, and then that allows us to figure the taxable income. Once we figure the taxable income, then there are certain what are called tax credits that are actual deductions from the income tax in arriving at what you actually owe, what we call the tax liability. So let's walk through this and look at how we calculate taxable income. First of all, we start with determining adjusted gross income, and actually to get there we start with gross income. For the most part, anything you do that generates income is going to be taxable to you. It's the first measure of income, and types of income subject to taxation include these things. Earned income, like when you work as an employee, you earn a salary or wages. You know, that's where you actually work as a laborer. Well, even as a teacher, as a salesperson, whatever, you've got, including commissions, you've got earned income. Investment income, of course, is money received from dividends and interest on stocks, bonds, savings accounts, other types of investments that you might have that are not in the form of a tax shelter type investment. So those generate investment income. Passive income results from business activities in which you do not directly participate, such as a limited partnership. For instance, you may own some rental property as a non-active owner. You're a limited partner there. You don't really actively engage in managing that, and so that's classified as passive income. And that's going to have some special treatment under tax law. Alimony, awards, lottery winnings. This is kind of a catch-all category here, so just about anything else in which that you generate profits in. I think I've mentioned in class today, if you've got a hobby, let's say your hobby is photography. There was a former student who approached me just over the summer, and she said she wants to start a photography business. But, well, you generally start that sort of thing out as a hobby. You do it for free, you learn your lessons, you know, you get some idea of whether you can make any money at it and what it takes to be successful in that, before you really start, as we say, hanging out your shingle and start actually advertising and pursuing it as a commercial enterprise. Well, if you start a hobby like that and you make money at it, in other words, you generate more revenues than the expenses associated with that, it's taxable. That difference, that profit is taxable. If you did the same thing and you have a loss, that is, your expenses exceed your profits, that's not deductible as in, you know, from your other taxable income. So I think I mentioned this today. If you look for fairness in the tax code, well, it's going to be a long and let's say fruitless search, because you're not going to find it there. If you alimony, notice here, if you receive alimony, that's taxable income to you. Child support, by the way, is not taxable, but alimony is. Any sort of awards that you get, later on in class we'll talk about scholarships. What types of income that you might receive or benefits you might receive as a student are taxable. Some of those may be and some of them may not. Lottery winnings, prizes, awards, things like that, those are also going to be taxable income.